Good evening, everybody, and good afternoon, everybody, and welcome to November 16th, Monday. I want to show a couple Wyckoff principles that are pretty key, pretty important. And this is the day's trading. It's our daily video. And I want to show you the market we returned from the Europe opening and going forward to the day's session in Chicago. This is where Europe opens around 2 o'clock in the morning, Chicago time. I'm going to mark this as a criteria of where we're going to begin our chart from. So we have a market that comes a little bit off the high, nothing nondescript, and we don't do anything here. This little spring, this spring here, right here, this little behavior right here, has to make a new high. We talk about it all the time. Has to make a new high to the markets. So we get selling before the new high, so we're going to mark this area as resistance. Very simple. Market now make a new high. We got selling. We got long liquidation to the markets, and we're often running in the sense of the longs getting out. Market now make a new high. This market did not make a new high. It was a spring attempt. Since this bar here made the new high, the low here before the high, I'm going to mark this bar as well. So we draw that line across, kind of a line in the sand type of thing where the market reacts lower and then makes a new high. When this gets taken out, it becomes bearish. Market comes down here, no real supply, but long liquidation. Remember, volume is relative. Then we get this bar right here. This is relatively high volume compared to the small volume we have. But remember, the key is the reaction of the markets. The reaction from the possible spring position is very, very weak. Matter of fact, it doesn't even go into the LPSY area. This is very weak market. Okay? Well, we don't get a chance to sell this market here, quite frankly. But nice. But we were expecting maybe the market to go back in the LPSY area based on this close. So we don't have a trigger, unfortunately. So now really the kiss of death to the market becomes this bar. This potential spring that we get fails immediately. Okay? That's key. If this spring was successful, we would have made new highs. So again, a spring fails on the next bar. Here, the spring fails here, a couple hours later. Then we get a series of upthrusts. This was a very difficult upthrust to take. But again, we want to mark this area because that's where the market came down from. If we take this reactionary high and draw this across, this will allow us to get a market. This is what I've been harping on, letting the market establish itself. This is UTAD. This is an upthrust after distribution. So the market's selling off, weak demand, selling, weak demand going down, no stopping action, no demand here. Market then rallies. We're not going to take this spring from weakness. We're waiting for an upthrust ending action. This is the best trade from the standpoint of the safest trade. Markets establish a down move, an upthrust, an increasing volume. Buy stops get hit. Selling comes in. This trade is here. Here is your sell edge. This is late in the game, so this is more for maybe people that don't recognize it. Your sell is here. Your stop becomes above the UTAD. Your stop is here. And you're still short the market. This is a short covering right here at the end of the day. So if you get above this area here, you want to get out. But if you get to the point where the market makes another low, your potential of this particular trade, that's all said and done here. If you take your reverse trend line in the market down here at the 3660 area to the downside, as you can see the market maybe going down to the area right now. Why I draw this line? It's a reaction low before we went here. This market then tried to react from here, and now we're here. So what you have is you have selling tails that's occurring all the way down, and selling overcomes buying. So initial buying that you saw in Europe, it's selling to the markets, a series of selling aspects of the market. these selling tails and selling bars gives you the upthrust of the distribution and now weakness, and now you're testing, retesting of the low, and our reverse trend line here would be our initial short target to the trade. And this is the anatomy of a market that turned from being bullish, taking out support, the kiss of death in a sense here. The market does not react to the spring. The key was not making new highs here. Weakness, and an upthrust and distribution is the safest trade because the market's established a down, and then you're covering down here. So really a nice illustration. This is the 15-minute E-mini S&P chart. 5 as we're speaking. E-mini chart, 15 minutes E-mini S&P chart. Type live chart here, obviously the market going down, and you're coming to the point where the market's trying to hold up in here and maybe reach down to the reverse trend line. So you're having now a market that has lower highs, a market that has lower lows. The market reaction to up bars, the green bars are weaker than the down bars. See the yellow, red here indicates selling. They're greater than the up bars. Here the green was stronger, and then it began to diminish all the way through. So this is the anatomy of a market that went from a bullish trading range, breaking of the ice, lack of buying, lack of recovery, up in the retest of the breaking of the ice and breaking down, but all started because we did not make a spring, did not make a new high, initiated a long liquidation, and then selling to the markets. So a very, very nice chart to illustrate things, bearishness in the market, and that's a 15-minute E-mini S&P from November 16th.